Hey everyone, welcome back to Corporate Decoder. Today CNVS just filed an 8K and I'm seeing a move that could be a sign of things to come. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is exchanging preferred stock for common stock, and the details tell an interesting story about their capital structure. Alright, so Cineverse Corp, a company in the entertainment sector, has filed a current report on Form 8K. This is usually for significant events that shareholders need to know about quickly. The main event here happened on the 27th of April, 2026. This report comes from Cineverse Corp, which you might know from their ticker symbol CNVS on the Nasdaq. Looking at their market cap, it is around $52 million and they have about 213 employees. Recently, there has been some buzz, with headlines suggesting the stock surged back in late April, even breaching its 100-day moving average. Investors have been debating if the market is underestimating them given their stock performance versus their financials. Cineverse has Class A common stock trading under the symbol CNVs on the Nasdaq. The core of this filing is about a new agreement Cineverse entered into on the 27th of April, 2026. They signed an exchange agreement with OCI Cinedigm LLC. This agreement involves Cineverse issuing its common stock in exchange for OCI Cinedigm's series of preferred stock. This is a move to simplify their capital structure, essentially swapping one type of ownership for another. Here is the key detail. Cineverse is going to give out its common stock to get back 3.118 shares of their series of preferred stock from OCI Cinedigm. This exchange isn't happening all at once. It is structured in 5 equal parts called tranches. The first one starts on May 1st, 2026. The number of common shares they will issue for each tranche isn't a fixed number. It depends on the value of the preferred stock being exchanged at that specific time. They'll calculate this by looking at the average stock price over the 5 days before the exchange happens. This means the number of shares issued could fluctuate based on market prices. Importantly, Cineverse has the authority to issue up to 1.5 million shares of its common stock as part of this deal. When they get the preferred stock back, those shares will be retired, meaning they go back to being authorized but not yet issued shares. This is a move to streamline their outstanding ownership types. This exchange falls under a specific exemption in securities law, meaning these shares being issued are not registered with the SEC in the typical way. This is permitted under Section 3 and 9 of the Securities Act of 1933, which usually applies to exchanges between a company and its existing security holders. As for exhibits, they've included the actual exchange agreement itself as Exhibit 10.1. This is the actual contract detailing the terms of the exchange. The report is signed by Gary S. Lafredo, who is their Chief Legal Officer, Secretary, and a Senior Advisor. The filing date for this report is May 1st, 2026, a few days after the agreement was signed. Now, let's put this into perspective. Cineverse is trading at a market cap of around $52 million. They're essentially swapping preferred stock for common stock. This can be a way for a company to reduce preferred dividends or simplify its ownership structure. When Cineverse does this over 5 tranches, it means they are carefully managing the issuance of new shares. The fact that they are authorized to issue up to 1.5 million shares of common stock is a notable amount. Given their current market cap, if they issue the full amount, it could represent a significant portion of their existing shares outstanding, leading to dilution. For example, if they have, say, 10 million shares outstanding now, issuing 1.5 million would be a 15% dilution. This kind of dilution can put downward pressure on the stock price if the market perceives it negatively or if the influx of shares isn't matched by increased company value. We've seen companies use these kinds of exchanges before. Sometimes it is a sign of strength, showing they can actively manage their capital. Other times, it can signal that they're struggling to raise cash through traditional means and are resorting to issuing stock. Given the recent headlines about the stock price surge, this exchange might be part of a larger strategy to stabilize or boost the share price by addressing complex equity structures. However, the potential for dilution is something investors will be watching very closely. What I am actually looking for is how this affects their earnings per share and how the market reacts to the ongoing issuance of new common stock over the next few months. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.